How's it going, everybody? Welcome back to the channel. My name is Mark and this is 360 Finance. I'm trying something a little bit different today. I am recording directly from my computer with a mic. So if the audio sounds different at all, just let me know down in the comments and I'll try to fix it for the next video. But I've gone ahead and built a spreadsheet on my computer today that I want to share with you guys. As you know, the topic of today's video is how much house can you afford, and I'm going to go through the specifics and details as to what you should be looking at, things you want to avoid, and also how you can, I guess, change a lot of the variables in this equation to be more favorable for you. Okay, so as you guys know, the housing market in Canada has gone absolutely bonkers in the last year for a variety of reasons. Obviously low interest rates are contributing to that. The liquidity provided by the Canadian government is contributing to that, and then also the work from home trend continues to also contribute to that. I think personally the biggest factor is the interest rates. Just being a finance person, you know that interest rates affect valuations of everything, especially when it's a direct factor in the calculation of the value of a home. But anyways, that's not the purpose of this video. I just wanted to say that so I could throw up a few graphics that I've seen all over social media so that you guys can see how crazy the real estate market has gone in Canada. Anyways, the topic of today's video is going to be how much house that you can afford based on the CMHC's guidelines, based on their percentage that you cannot exceed in your gross service debt ratio as well as your total debt service ratio. We're going to go through all that if you don't know what that is, but basically what I have here is a spreadsheet for you guys, and it's a mortgage calculator, okay? And then I have a bunch of different inputs and variables that you will need to input in order to determine what your gross debt service ratio as well as your total debt service ratio is. And I guess actually just maybe to explain, everything in yellow is going to be an input, okay? Something that you're going to need to change, and then everything else is basically auto-calculated based on the formulas that I've inputted, okay? So at the start here, you have the principal amount of a home. If we maybe just use the scenario that I went with, I had bought a home for about $500,000, okay? And I had put down 20% on the house, roughly. I have a note here that says to avoid the CMHC mortgage loan insurance. Conveniently, on the left-hand side of the screen here, I have the mortgage loan insurance costs and how that works. I will link the CMHC websites in the description if you want to visit any of these sites and just check how this is calculated. But essentially what the mortgage loan insurance is an additional fee if you don't put 20% down on your home. In my situation, I was able to save up 20% for a home, which I know is quite a bit of money. You definitely have to make a lot of sacrifices to hit 20%, but that was basically 100 grand for me. So the principal of my home was about $500,000. I put down 20%, which was 100 grand, and then I have a mortgage amount of $400,000. I do have an if scenario in here, and the reason I did that is if the down payment percentage that you put down was less than 20%, you basically have to add, essentially what I was quoted is if I don't put 20% down, they're going to add about 20,000 to my home. So I just add 20,000 in this if scenario. So you can see if I put this down to 15%, it's going to add an additional $20,000 because I have put down less than 20%. Anyways, I was able to avoid that, and that'd be basically my first tip. You want to avoid having to pay excess insurance costs for no reason, basically. The next thing to input is going to be your annual interest rate, and interest rates are extremely low right now. The one that we were able to achieve is 2.04% on our mortgage. This is going to kind of depend on a lot of factors, but the bank will quote you something unique to your own personal scenario and the industry that you work in as well as your income. We were quoted 2.04%. The Bank of Canada has interest rates extremely low right now, and they will be hiked in the future. And that's why the housing market, in my opinion, has gone crazy in the past year, because interest rates are so low. Investors as well as just regular families are just looking to scoop up these homes so that they can lock in at a fixed rate that's extremely low for the next 5 years. After that, you want the number of years of the mortgage. For us, it was 25 years fixed for the next 5, and then we can renegotiate. And we are actually paying bi-weekly, but just for the sake of simplicity, the number of payments per year, I put in 12 here, assuming that you're going to pay once a month. And what that does is that conveniently calculates your payment per period. And to do that, all you need to do is insert a payment function, and maybe I'll just do it here real quick. Okay, so you can see periodic payment for an annuity investment like a mortgage. What it's asking for is your rate, the number of periods, the present value, and then the future value or end or beginning value. But you don't need to add the future value or the end or beginning. All you need to do is add the rate, the number of periods, and the present value. So I have B6 divided by B8, okay, so 2.04 0.4% divided by 12, which gives me my monthly interest rate. And then I have B7 times B8, which is the number of payments in total for the life of the mortgage, which is number of years times payment per year. And then you have B5, which is the mortgage amount. What that does is it calculates the payment you're going to be paying on a monthly basis, which is about $1,700. So total paid over the life of this mortgage will be about $510,000, or an interest cost of about $11,000. Now, it's interesting to see how you change these inputs, how the total interest paid will change. Your goal when buying a home is going to be to lower the amount of interest paid as much as you can, okay? And that will depend on your debt. Percentage down payment, that will also depend on your principal, okay? So all these variables have a massive effect on your total interest paid. Your goal should be, at least depending on who you are as a person, but your goal should be to minimize your interest paid over the life of the mortgage. The next thing you're going to want to look at here is your property tax. This will again vary based on the property you buy. Mine was about $5,000 for the year. Okay, divide that by 12, and you're going to be adding that to your costs in order to get to your gross debt service ratio. After that, you're going to add your insurance. I've just added in $1,000 for the year for insurance just for the sake of simplicity. Again, this is going to vary based on the type of home that you buy, as well as the potential risk factors associated with that home. So basically that adds about $500 to my monthly payment on top of my mortgage. To get to the gross debt service ratio, I will go to the second CMHC tab that I have open here, and how they essentially calculate as principal, which is this amount right here, plus interest, which is also baked into this amount right here, the 1703. And then you're going to add your taxes as well as your heat. So heat is basically your utilities. It doesn't technically use insurance, so I guess I could probably take that out of the calculation, but I've included it because it is a sunk cost. You're going to have to pay home insurance. You might as well add it to the bill for now. So if you add your mortgage, your tax, your insurance, plus your utilities, mine is roughly $300 a month. Again, it varies based on the amount of heat and water that you use. Basically, total cost to live in this home, mortgage, tax, insurance, plus utilities, about $2,500. Now, the last thing you'll need in order to get your total debt service ratio is any other monthly obligations that you have, okay? Like if you have any car payments, you have any credit cards, you have any other mortgages, anything that you have to pay on a monthly basis, which is considered debt. For me, that's car payments, which is roughly $400 a month, or up to $2,700 a month in total payments. Okay, now let's come over to the second side of the spreadsheet here, which is going to be your income, which will ultimately bake into your GDS as well as your TDS. Now, it's important to note that the CMHC will restrict you on your mortgage if you are over 35% on your GDS or over 42% on your TDS. Okay, so what we're trying to do here is get these numbers below 35% and this one below 42%. Let's just say you and your partner, you're making about $50,000 a year. Again, input your own income numbers and any additional money you get from side hustles. Like maybe you have a YouTube channel and you're trying to blow up on the internet or something, and this number is going to go to 100,000, and then you're well below your GDS and your TDS. Just kidding. Anyways, so just for the sake of simplicity, I've used 50 grand in the income numbers here. A lot of people have different philosophies on this. I'm using CMHC's guidelines because these are the most standard ones that you will see in Canada, and they basically don't want you to go above 35% or 42% on your GDS and your TDS, okay? So you add up your income numbers here, you're at 105,000 gross income. You shouldn't use your gross income to calculate your GDS or your TDS. You should be using your net income, obviously. I mean, why would anybody calculate anything based on their gross income? You want your take-home pay to calculate these numbers, okay? So this number is going to change based on the tax brackets that you're in. I've just conservatively used 70%. That's roughly take-home pay, depending on which tax bracket you're in. Like obviously, if we put up these up to $110,000, you're going to be in a much higher tax bracket. 70% is a pretty conservative estimate that basically leaves you with a monthly net income of just over $6,000. As you can see here, we are over 35% on our GDS, and we are also over 42% on our TDS. So the best way in order to determine how much house that you can truly afford is by getting these numbers under the required thresholds, okay? So instead of buying a house for $500,000, maybe you look at something that is closer to the $400,000 range. So we're slightly still over the GDS as well as the TDS is under 42%, but we want to make sure that the GDS, which is the important one really in my opinion, is under 35%. So maybe you look at 395, 1, 2, 3, and we're still over it. Lower that interest rate. There we go. Okay, so in my opinion, these people, let's say income 1 and 2, let's call them John and Jane. Okay, John and Jane are house poor in my opinion because they're literally right at the limit as to what the CMHC is recommending as max GDS and TDS. So their monthly net income is $6,000. But after you factor in basically their housing costs, they're only left with $3,800. Now, you have to think about, you also have to buy groceries, you're going to have discretionary expenses, maybe you have to furnish your home, maybe you're trying to have a wedding, and then any other fun money, like if you want to save money for traveling, if you want to save money for investments. This is pretty high. Usually you're going to want to, in my opinion, get a little bit lower than this. I would recommend when you're buying a home that this actually doesn't go anywhere above 30% on your GDS. Again, if you're only making $50,000 between you and your partner, maybe you look at a home that's only $300,000 and 100% try to put that 20% down payment in order to avoid the CMHC mortgage loan insurance. Now, this interest rate is pretty low, and the Bank of Canada as well as the Fed has stated that interest rates are going to stay this low at least until 2023. So if you're looking to buy a home, you might want to do that before 2023 when these interest rates go back up so that you can lock in a fixed interest rate under 2.5%, 2%. Like I said, myself and my partner were able to lock in 2.04%. And we bought a home for $500,000. Obviously, I'm not going to give you guys our income, but just to give you guys an idea of how much house that you can afford, you're going to want to keep your GDS under 35%. And I would recommend you keep it under 30% so you can also save money for travel. You can also save money for investments. You don't want to stretch yourself out too thin. So that's pretty much all I have for you guys today. I hope you guys did enjoy this video, a little bit of a new format. And if you like these spreadsheet videos, I definitely got other spreadsheets to share if you guys are interested in that. So definitely let me know. And if you want this spreadsheet, you can hit me up on social media or on the YouTube comments or whatever anyway, or email me directly, whatever you would prefer, okay? So moral of the video, keep your GDS under 35%. I would recommend under 30%. Don't make a stupid decision when buying a home. Interest rates are at all-time lows right now. Housing prices are at all-time highs. Hope you guys enjoyed, and I'll see you guys in the next video. Peace.